The next question that we'll be dealing with, again, as I've said, is from Type Letter 106 from 2010, and it'll be found on page 117. If you are having reference to Type Letter 106 2010, maybe you've still got it in your files from last year. I'm hoping not, but anyway. And if not, it is attached to this DVD. So we're looking at question 2 on page 117 of Type Letter 106 of 2010, and the suggested solution is also contained in the Type Letter. Now this is a previous question that UNISA gave as a test or an exam question, and we can work through it because it deals with a lot of the aspects dealt with in Type Letter 106. So on the 1st of March 2009, Mrs. Lamini created the Lamini Family Trust with a February year end and made a 100,000 Rand cash donation, which was invested in a 10% simple interest per annum bearing call account to the trust. So what she does is in 2009, Mrs. Lamini forms the trust and donates 100,000 to the trust. The trust takes 100,000 and puts it into an interest bearing account. The beneficiaries of the trust are Mrs. Lamini's nephews, Thabo, who's 32 years old and who immigrated from South Africa to the UK in 2003. Now remember, the type of thing we want to be looking for are beneficiaries of the trust who are either spouses of someone who's donated something to the trust, who are minor children of someone who's donated something to the trust, or any beneficiary who is a non-resident. So already here we've got Thabo, who's a beneficiary to the trust, and he's a non-resident. So Mrs. Lamini's nephews, Thabo and Tanda, who's 30 years old and a resident in the Republic. Trust income can be distributed to the beneficiaries annually at the discretion of the trustees. So this is a discretionary inter vivos trust, and it's an inter vivos trust because it was established while Mrs. Lamini was alive. She's given the trustees a whole lot of decisions that they can or can't make, so therefore they've got a lot of discretion. The trust deed provides for 3 trustees, namely Mrs. Lamini herself, her auditor, and her husband, Mr. Lamini. Mrs. Lamini, a 67-year-old resident, died on the 31st of July 2009. When Mrs. Lamini died, her attorney, very Sharp, was duly appointed, as all attorneys are, by the way. Her attorney, V. Sharp, was duly appointed in her place as a trustee of the Lamini Family Trust. Mrs. Lamini left all her worldly goods to her husband, Mr. Lamini, who's 70 years old, to whom she was married out of community of property. Her assets consisted of the following. She had a share portfolio in the Republic, and this portfolio consisted of listed shares. They were bought and in a resident company. They cost 123,000 and at her date of death had a market value of 154,000. Mrs. Lamini also had a collective investment scheme in property. This had a cost her 54,000. It had a market value of 67,000, and we see that it was subsequently sold, but it was sold on the 15th of August 2009, clearly after Mrs. Lamini had passed away, because she passed away on the 31st of July 2009. So let's look at the notes. The executor received a Section 11S dividend of 6,000 on the 30th of August 2009 from the collective investment scheme in properties that was paid to investors registered on the 14th of July 2009. Now I want you to be a little bit careful of that, because remember, despite Mrs. Lamini having passed away on the 31st of July 2009, she will still be regarded as a fully taxable taxpayer up to and including her date of death, the 31st of July. So therefore, we must be aware that all receipts and accruals that Mrs. Lamini enjoyed up to and including her date of death will be included in a taxable income we calculate for her up to the 31st of July. So let's have a look at that note again, and it says to us that the executor received an 11S dividend, which would be one of those non-tax-free dividends paid out by the collective investment scheme. But it was paid out to investors registered on the 14th of July. Now, if Mrs. Lamini only passed away on the 31st of July, any tax consequences of the receipt of that 11S dividend would have actually accrued to her before her date of death. Because remember, an amount enters your gross income at the earlier of the receipt or the accrual of that amount. So because it accrued to Mrs. Dlamini before her date of death, the tax consequences of that 11S dividend will have to be taken into account in Mrs. Dlamini's hands for her own taxable income purposes. On the 15th of September 2009, interim dividends on the listed shares of 7,500 were paid into Mr. Dlamini's account. Investors had to be registered on the 31st of August 2009. Now, clearly that is after the date of Mrs. Dlamini's passing, and she left all her assets to her surviving husband. So we must have a look at whether he is the actual has the legal entitlement to that dividend. On the 28th of February 2010, a final dividend to the value of 15,000 was paid to Mr. Dlamini on the listed shares. The holiday house, remember, one of her assets we looked at. She had share portfolio, holiday house, Krugerrand's money market account. So in her assets that we looked at, the holiday house was exclusively used by Mr. and Mrs. Dlamini. What is this telling us? This holiday home was used not for trade purposes, but for their private purposes. So therefore, it's always been a capital asset in their hands. 2 months after Mrs. Dlamini's death, that is October 2009, Mr. Dlamini decided to sell the holiday house to the existing Dlamini family trust, and he sold it for $2,170,000, the market value. The trust immediately concluded a rental agreement for $7,500 a month. So what's happened is Mrs. Dlamini's died. She's left that holiday home that she owned in Port Elizabeth to her surviving spouse. Very shortly after that, Mr. Dlamini sells that holiday home to the trust. The trust is then the owner of the holiday home, and the trust rents out that holiday home. So let's have a look. That was 2 months after her death, the 1st of October 2009, when Mr. Dlamini sold that holiday home to the trust. So let's have a look at what Mr. Dlamini does then. The purchase price, that is what the holiday home paid, what the trust paid for the holiday home, was financed by way of an interest-free loan from Mr. Dlamini. So Mr. Dlamini sold it for the amount of just over $2 million and said to the trust, although you owe me the money, we'll make it an interest-free loan. I won't charge you interest. You can assume that the market-related interest rate is 9% per annum and that Mr. Dlamini is forfeiting 81,375 Rand interest from the period of 1 October when he sold the property to the trust to the 28th of February 2010. Now, what do we always know when we see that there has been an interest-free loan to a trust? We know that to the extent of any interest saved by the trust on not having to pay interest on a loan, that will have created income in the trust equal to the interest saved. So if we look at that 81,375, because the trust is not paying Mr. Dlamini interest, there will be extra income in the trust as a result of that of 81,375. So what Mr. Dlamini's done is he's made a disposition to the trust. He's given the trust something with an element of gratuity, an interest-free loan. The loan is not a donation, but the interest-free part is an element of gratuitousness. It's a settlement with similar disposition. So as a result of Mr. Dlamini doing that, extending the interest-free loan to the trust, what income has arisen in the trust because of that? Well, the interest saved by the trust is as a direct result of the disposition of that interest-free loan, and that is the amount of the 81,375. So be careful of that for Mr. Dlamini.